Welcome to the Deep Dive.
Great to be here.
Today we're taking a close look at the Indian auto ancillary sector. It's quite a fascinating space.
Absolutely. It's really caught between its traditional growth engines and, well, the whole EV revolution that's unfolding.
Right. You have these companies historically focused on components for, regular petrol and diesel cars.
Internal combustion engines, yeah. And now they're at this crossroads. Big changes happening.
So our mission today is to really understand the forces shaping this sector.
And maybe get a sense of potential winners and losers.
Exactly. We want to figure out who's positioned well, who might struggle a bit.
Okay.
And we're basing this on a pretty comprehensive analysis from Ambit Capital.
Yes, a solid report. They really dig into the companies and the big picture trends. They do.
So let's dive in. What are the main things driving growth for these auto component guys right now?
Well, the report highlights several key drivers. First off, there's just more stuff going into each car. Increased content per vehicle.
More stuff? Meaning more complex parts? Or just more parts overall?
Both, really. It's not just selling more of the same old components. It's about more advanced, more sophisticated features being demanded.
Okay. And what's driving that demand?
A big one is premiumization. Indian buyers want more features.
Oh, right. SUVs over hatchbacks, top-end variants.
Precisely. People want the sunroofs, the better infotainment, the ADS, advanced driver assistance systems.
Do we have numbers on that? Is it a noticeable trend?
Yeah, definitely. The report mentioned sunroofs, for instance. Penetration went from about 50% in Q3 FY24 to 52% in Q3 FY25. Similar story for ADAS, up from 52% to 54% in the same period.
Small increases, but consistent.
And connectivity features, too. Back in 2019, maybe 19% of models had them. Now it's closer to 37%. Even specific models like the Maruti Dzire are seeing more demand for the top variants.
So customers wanting more bells and whistles directly means more business for suppliers.
That's a huge part of it.
What else is pushing up the component content?
Regulations, that's another massive driver.
Emission norms, safety standards, that sort of thing.
Exactly. India's been tightening emission rules steadily. The Bharat stage norms, right?
Yeah.
We're at BSVI now.
And more coming, I gather.
Yes. TREM 5 for tractors is scheduled for April 26, and CAFE 3 for passenger vehicles in April 27.
CFAB.
Corporate average fuel economy. Stricter standards mean more advanced tech.
Like what, specifically?
Things like better fuel injection, more sophisticated emission controls.
Yeah.
DPFs, SCR, GPFs.
The filters and catalysts.
Diesel particulate filters, selective catalytic reduction, gasoline particulate filters, yes. Plus more sensors. NOx sensors, particulate matter sensors. The works.
So complexity goes up?
Significantly.
Yeah.
And even the push for lightweighting, making cars lighter to meet emission targets, creates openings for suppliers using advanced materials.
Right. Interesting. So emissions drive tech. What about safety regs?
Also huge. Things like ABS, airbags becoming mandatory.
Driver's side airbag was 2021, wasn't it?
Correct. Plus speed alerts, seatbelt reminders, reverse parking sensors, all mandated now.
And Bharat NCAP ratings push for even more safety features voluntarily.
Exactly. Manufacturers want those good safety ratings.
Yeah.
And it's not just cars. Even things like mandatory AC cabins and trucks create demand for specific components.
So it's a mix. Consumer wants government mandates, leading to more complex, feature-rich vehicles.
That's the core idea for increased content.
Now, the elephant in the room, EVs. How are electric vehicles changing the game for these suppliers?
EVs. Oh, they're a real mixed bag. It's interesting.
Awesome.
On one hand, boom. New components needed, lithium-ion batteries, traction motors, controllers, battery management systems. Completely new stuff.
Stuff IC cars just don't have.
Right. But on the other hand, some existing components actually need more content in EVs.
Like what?
Wiring harnesses are a prime example. They need about twice the content in an electric two-wheeler compared to an ICE one.
Twice? Wow.
And for cars, it's roughly 3 times the wiring harness content compared to an equivalent ICE vehicle.
So more complex wiring for all the electric systems.
Exactly. So it creates this strategic puzzle for suppliers, doesn't it?
Yeah. Do you focus on adapting your current lines or jump headfirst into completely new EV tech?
Knowing that your old ICE business might eventually fade,
Yeah.
it's a tough call.
The report suggests the EV transition in India might be gradual, at least for now.
That's the projection, yes. For two-wheelers, maybe 21% EV penetration by FY29.
Okay. And passenger cars?
Lower, around 10.4% by FY29 is the estimate. Three-wheelers, though, are expected to electrify much faster.
Really? How fast?
The forecast is nearly 68% EV penetration for three-wheelers by FY29.
Wow, okay, so it varies hugely by segment.
It does. And this gradual pace overall gives suppliers some time to adjust.
Yeah.
But they definitely need to be planning and investing now.
Makes sense. Are there totally new product areas opening up beyond just swapping IC parts for EV parts?
Oh, for sure. EVs and general tech advancements are paving the way for things like regenerative braking systems.
Right, capturing energy back.
More advanced ADS features. Smart cockpits with integrated displays and controls. These are whole new revenue streams opening up.
So plenty happening on the domestic front. What about looking outwards, international markets?
That's another major growth avenue.
Yeah.
India has cost advantages in manufacturing, right?
Generally, yes.
And a pretty developed ecosystem, especially for mechanical parts. So exports are attractive.
How are we doing on that front?
India was ranked 18th in global auto component trade in 2024. Our share with big importers like the U.S. is growing.
Any growth numbers?
Exports from the NSE 500 listed auto ancillaries grew at a 12% CAGR between FY09 and FY24. That's pretty healthy.
12% CAGR over 15 years. Not bad at all.
Definitely solid growth.
And isn't there also a big push for localization? Making more stuff in India?
Absolutely. Reducing import dependence is a major focus.
Government policies helping there.
Yes, things like the PLI schemes,
Mm-hmm.
production-linked incentives for auto and auto components, and also for ACC battery storage. Advanced chemistry cell batteries. Plus, schemes like FAME2 for EVs often have domestic value addition requirements built in.
So incentives to manufacture locally, are we seeing results?
Yeah, the report notes that the foreign exchange outflow from OEMs is actually decreasing, and lithium-ion battery capacity in India is set to jump quite sharply by FY26.
Okay, good signs. It also seems like these companies aren't just sticking to autos anymore.
That's another key strategy, diversification. Moving into non-auto segments, or adjacencies, as the report calls them.
Using existing skills in new areas.
Exactly. Leveraging their expertise in things like forging or aluminum casting to tap into sectors like defense, aerospace, renewables, oil and gas, railways, power generation.
Makes sense. If you can forge a crankshaft, maybe you can forge something for a wind turbine.
Something like that, yeah. It spreads the risk and opens new growth paths.
And finally, the report mentions M&A, mergers and acquisitions.
Right. Both local deals and global ones. It's a way to quickly acquire new capabilities, enter new markets, or just build scale.
Okay, so summarizing the growth drivers.
Mm-hmm.
More content per vehicle thanks to premiumization and regulations.
Mm-hmm.
The EV shift, bringing new components and boosting others, new product development.
Exports, leveraging cost advantages, localization efforts.
Diversification into non-auto sectors and M&A activity. Quite a list.
It is. Lots of potential upside.
But of course, it's not all smooth sailing. There are challenges, headwinds too, right?
Definitely. And some significant ones.
What are the main worries?
Well, the flip side of the EV transition is the risk for companies heavily reliant on ICE components.
The ones making engine parts, transmission.
Exactly. Engine components alone were about 26% of industry revenue in FY24, according to the report. If your main business is making pistons or fuel injectors for petrol cars, that's a major long-term risk if you don't adapt.
A fundamental threat, really.
It is. Then there are the broader economic factors.
Global slowdown worry.
Yeah, uncertainties globally. Weakness in key EV markets like the EU or China could hurt demand for Indian components.
And trade policies, always a potential issue.
Yeah, very much so. U.S. policies like the USMCA trade deal or potential new import tariffs are a risk.
How big a market is North America for Indian exports?
Significant. Around 32% of India's auto component exports go there.
So tariffs could really bite.
The report even gives an example. Potential tariffs on new radial tires could jump from 2.5% all the way up to 27.5%.
Ouch. That would drastically change the economics.
It absolutely would.
What about Europe? We mentioned potential weakness there.
Yeah, the EU market has its own issues. Demand is a bit soft overall.
Competition heating up.
Big time. Especially from Chinese EV makers gaining traction there. And EV adoption maybe isn't happening as fast as some hoped across all segments.
Impacting the European car companies.
We're seeing that. Profit warnings from VW, Stellantis, Mercedes, Porsche, even job cuts in some cases.
And the EU is also a big export market for India.
Just as big as North America, roughly. About 32.5% of exports in FY24. So weakness there directly impacts Indian suppliers.
Which companies are most exposed?
The report names Motherso, BHFC, Endu, and Sonocoms as having higher exposure to the EU. And that rising market share of Chinese brands in the EU is definitely something to watch.
So domestic potential is strong, but the global picture adds quite a bit of risk and uncertainty.
That sums it up well.
Are there also just inherent differences between the ancillaries and the big OEMs, the vehicle manufacturers, in terms of business dynamics?
Yes, the report touches on that too. Generally, ancillaries might see slightly slower revenue and EBIT growth compared to the OEMs.
Lower margins, too.
Typically, yes, lower EBITDA margins. Although, interestingly, their profit after tax growth can sometimes look better.
How does that work?
Well, the report notes that's not adjusted for potential equity dilution. So maybe not a perfect comparison at the bottom line. But core operating profitability tends to be lower for ancillaries.
Less pricing power, maybe?
Likely a factor, yes. OEMs often have more leverage.
What about cash flow and capital? How do they stack up?
That's another area of difference. Ancillaries often face tougher payment terms.
Meaning they wait longer to get paid?
Or have to pay their own suppliers sooner, yeah. It leads to weaker cash flow dynamics.
Yeah.
OEMs often have a negative cash conversion cycle. They get paid before they pay out.
Nice position to be in.
For them, yes. Ancillaries usually have a positive cycle, maybe around 56 days, according to the report's data.
And capital expenditure, CapEx.
Generally higher for ancillaries as a percentage of sales, around 7.9% on average versus 4.5% for OEMs in the study period.
So higher investment needs weaker cash cycles.
Which can lead to lower capital efficiency overall. Lower CFO to EBITDA conversion, lower conversion of profit to free cash flow, lower asset turns, lower ROCEs generally.
Okay, so a tougher operating environment in some ways, despite the growth opportunities.
It requires careful management, definitely.
Right. Now, the Ambit Capital report doesn't just talk trends, it names names. It evaluates specific companies. How do they do that? What's their framework?
They use a structured approach, looking at three main things for each company: business fundamentals, financial performance, and valuation.
Okay. What goes into business fundamentals?
Things like diversification across products, geographies, customers, their leadership position in their specific segments.
Market share, basically.
Yeah, and competitive strength. Also, their scope to grow faster than the market and the overall risk profile of the business. They score companies on these points.
So a multi-factor assessment.
Very much so, combining the business view, the financial health, and whether the stock price looks reasonable.
And based on this scoring, they rank the companies. Some buys, some sells.
Exactly. The report clearly identifies top-ranked companies with BY recommendations.
And those are?
NU, Motherso, and Msumi come out on top.
Okay. And at the other end, the lower-ranked sell recommendations.
Those are BHFC, Sonocoms, and Happy4, according to this analysis.
ND Motherso, Msumi is buys, BHFC, Sonocoms, Happy4 is sells. That's pretty clear.
Yes, it gives a definite perspective based on their framework.
Let's dig into those a bit. Why NDU? What makes it a top pick?
NDU's strength is in the two-wheeler space. They're leaders in suspension, braking, alloy wheels, aluminum die casting for two-wheelers.
Okay, strong position.
And crucially, their portfolio is largely fuel agnostic. About 95% of what they make works for both ICE and EV platforms.
Ah, that helps navigate the transition.
Big time. Plus, they're expanding into four-wheelers and non-auto segments through partnerships and growing their wallet share with the big two-wheeler OEMs.
So diversifying and deepening relationships. How are their overseas ops? We mentioned EU exposure earlier.
Interestingly, their European operations are reported as showing strong growth, despite the market weakness there. They have a healthy order book, especially for EV and hybrid components.
So they're winning business even in a tough market.
Seems so. And financials look solid. Good revenue, EBITDA, and return on capital employed.
Okay, so leadership, fuel-agnostic portfolio, expansions, solid financials. That's NDU. What about Motherso, another BLI? Big global player, right?
Huge. Top 15 global auto supplier. Their key strength is diversification.
Geographies and products.
Both. Widely spread, and again, a largely fuel-agnostic product range. They have a strong order book, and the EV share within that is growing.
What else stands out for Motherso?
Their push into non-auto sectors is significant. Aerospace, but also electronics manufacturing services, EMS.
EMS, like contract manufacturing for electronics.
Exactly, through a joint venture with Beal Crystal. They're targeting mobile handset components initially, but potentially broader electronics too.
Big potential in India for that, with import substitution.
Massive potential. And the analysis suggests Motherso's current valuation doesn't fully capture this non-auto growth story.
So the market might be underappreciating the diversification play.
That seems to be Ambit's view, yes.
Okay, and the third BUY, MSUMI. What's their story?
MSUMI is all about wiring harnesses in India. They are the clear market leader, around 40% share.
Dominant position.
Very much. They're seen as a pure play on the Indian auto growth story.
How so?
They benefit directly from several key trends. More electronics in cars, premiumization, electrification, connected vehicles. All these trends generally mean more complex wiring harnesses.
Right, we talked about harness content increasing in EVs.
Exactly. Plus, they have strong margins, they turn over their assets efficiently, and consistently generate free cash flow.
And they're expanding capacity.
Yes. Building new greenfield plants for upcoming EV and ICE programs. That's expected to give their revenue a significant boost from the second half of FY26 onwards.
So, market leadership in a growing, essential segment, plus good financials and expansion. That's MSUMI.
That's the essence of the BUY case for them.
Okay, let's flip to the other side, the sell recommendations. Starting with BHFC, what are the concerns there?
BHFC has diversified, yes, into areas like defense and aerospace forging.
Which sound promising.
It is, longer term. But their core legacy auto business components for commercial vehicles and passenger vehicles faces a pretty muted growth outlook right now.
And global headwinds affecting them.
Yes, they're exposed to potential U.S. tariffs, the weakness in Europe we discussed, and the general EV transition risk for their traditional product lines.
Any specific drags on profit?
The report mentions their aluminum forging business has been hurting profitability.
So, while defense and aerospace are growth hopes,
The current challenges in auto and the drag from aluminum forging weigh things down, and the valuation is seen as rich, given these headwinds.
valuation too high for the risks involved. Got it. What about Sonocoms? Also a sell. They're global too, right?
Yes, significant global share in differential gears and starter motors, and they are pivoting to EVs.
Making EV gears.
EV-specific gears, assemblies, traction motors, controllers, yes, they're actively shifting. High international revenue exposure, too, around 72%.
So what's a problem if they're pivoting to EVs?
The risk lies in the pace and certainty of that EV adoption globally. Their order book is heavily tilted to EVs and plug-in hybrids,
Which could be great, but
but exposes them significantly if EV adoption slows down in key markets like the U.S. or Europe. Plus, the USMCA risk for exports and competition from Chinese EV component players.
so too much reliance on a potentially volatile global EV transition.
And the valuation, again, is seen as not fully reflecting these embedded risks.
Okay, makes sense. Lastly, Happy 4, third sell recommendation. What's the rationale here?
Happy 54 is India's third largest forging company. They focus on complex, high-value products.
And expanding.
Yes, moving into heavier forgings for non-auto sectors, oil and gas, renewables, defense, aerospace. Similar diversification strategy.
But near-term issues.
The near-term outlook for their key segments, commercial vehicles and exports to the EU, looks weak.
Okay.
They also have significant CapEx planned, big investments.
Which can strain finances.
It can, potentially impacting financials and free cash flow, especially if the demand outlook is weak. So near-term demand headwinds plus potential financial pressure from CapEx.
And the valuation doesn't fully capture these risks.
That's the conclusion of the report, yes.
Wow, okay. That's a really detailed run-through of the sector and specific players based on that Ambit Capital analysis. Very insightful.
It definitely provides a structured way to think about a complex industry.
So, to kind of wrap up our deep dive, what are the main takeaways for our listeners?
I think the key thing is that the Indian auto ancillary sector is genuinely at a crucial point. Huge opportunities, no doubt.
Driven by that rising content per vehicle, premiumization, regulations, the whole EV shift eventually.
Absolutely. But balanced against that are very real challenges. Global economic jitters, trade risks, and just the sheer speed of technological change.
And it's clear from the report's analysis that it's not a monolithic sector. Company specifics matter a lot.
Hugely important. Understanding individual company strategies, how well they're diversifying, their financial strength is going to be critical to figuring out who wins.
The analysis certainly suggests a very differentiated picture. Some look much better placed than others.
That's the clear message. It's not a rising tide lifts all boats scenario.
Right. So maybe a final thought for you, our listener, to chew on.
Go for it.
Given everything we've discussed, the tech shifts, the global policies, the domestic trends, which specific part or segment of this auto ancillary world do you think holds the most long-term promise? Is it EV batteries, advanced electronics, lightweight materials, something else entirely?
Interesting question.
And maybe what factors will ultimately separate the winners from the rest in this really dynamic industry?
Lots to think about there.
Definitely. Well, thank you for joining us for this deep dive.
My pleasure.